So the first question is a question on concepts, and they're asking us to choose the correct word from those that have been given in the brackets, and we need to write only the word next to the question number. So the first one says the current ratio is a financial indicator which is relevant to the liquidity or the solvency of the company. So which one do you guys think it is? Is it the liquidity or is it the solvency of a company? You can either unmute yourself or you can type in the chat box.
Hi, Sihle.
Hello.
You're sounding so far like I cannot hear you. I don't know, maybe the fault is on my side, but I don't know. I think Kay needs to confirm with me if they can clearly hear you because you sound like very, very far to me. So I just hear kancane nje.
Okay, Kay, confirm.
She sounds very clear on my side. I can hear you clearly. I think it's on
Okay,
your
all
side.
right, okay. I guess it's my speaker, all right.
Okay. Okay, so question number one, which one do we think it is? Liquidity or solvency? With the current ratio, what is it called? Which the current ratio is financial to liquidity or the solvency of the company? Which one is it? What do you guys think?
The liquidity.
The liquidity, that's correct. So liquidity looks at the short-term cash flows and solvency looks at the long-term. So the current ratio, those are short-term, so that's why it's liquidity. Then we continue. We have an increase in the fixed deposit will lead to an inflow or an outflow of cash in the cash flow statement. So you're increasing your investment, your fixed deposit. So what will that lead to? Inflow or outflow? What do you guys think? Right. So the answer there is an outflow because what's happening if you're increasing your fixed deposit, that means you are putting away more money at the bank. So money is leaving the business and going to the bank, making it an outflow. So you're increasing your investment, but you're decreasing your cash. Then a decrease in inventories will lead to an inflow or outflow of cash in the cash flow statement. Which one do we think it is?
Inflow.
It is an inflow because what would be happening? You would be selling your inventories. So if if they're decreasing, that means you're getting money because you are selling them. So that will be inflow. Okay. Now let's look at question 2.2. For question 2.2, they want us to complete the retained income note for the financial year ended 29th February 2024. Continue. For the main question, they've asked us to, what's this? They've asked us to complete the prepaid, what's this? The retained income note, sorry. So the retained income note, as you can see here, it's not written out in full. They are missing things. So what are those missing things that are supposed to be here? What's missing?
It would be net profit after tax
Yes, net profit.
and
You were saying net profit after tax is correct. What else could be?
yes, and shares repurchased.
Yeah, shares repurchased. And then under our ordinary shares,
It would be interim dividend.
interim dividends is correct. Okay, so that's our format for a retained income note. Now let's look at the information given in order to calculate our net profit after tax, our shares repurchased, and our interim dividends. So this is the information we've been given. Here, this is about share capital, and then they tell us that 1,450,000 shares are in issue on the 1st of March 2023, and then 30,000 shares are repurchased on 1st June 2023 at 3 Rand 70 above the average share price. So this is not the purchase price, but what we paid above the purchase price. Above the average price. And if you remember, when you're doing your retained income, the amount that you use for your share buyback is the amount of your purchase price minus your average price. So now they've already done that for us. So they've given us that amount, and it's 3 Rand 70. So we can use that to calculate the amount we'll be putting in our retained income note. And that will be 3 Rand 70 multiplied by, that will be 3 Rand 70 multiplied by 30,000 shares. 3.7 times 30,000, which will give us 111,000. And that's our shares repurchased. And remember to put it in brackets to show that it's negative, because this amount was above above the average share price, meaning we have paid more than what the value of the shares is. Okay, now let's continue. Dividends. Interim dividends were paid on the 31st of August 2023 to all shares in the share register, and they're not telling us how much the interim dividends were, and then a final dividend was declared on the 29th of February 2024. Okay, so we need to go back to that. Then we continue. They give us an extract from the Statement of Comprehensive Income. So this is where we should find how to calculate a net profit after tax. They've given us depreciation, operating profit, interest on loans, and income tax. And then they're saying income tax is at a rate of 30%. Now, if you're doing your statement of, when you're doing your statement of comprehensive income, to get to net profit after tax, you take net profit before tax, and then you have your income tax, and then you get your net profit after tax. And so you have whatever amount this is minus your income tax, and it will give you what your net profit after tax is. And to get your income tax, you take the net profit after tax and multiply whatever percentage they're telling you it is. In this case, they've told us it's 30%. So now if you want to find your net profit after tax, there are two ways to do this. They said this is 30%, so that means this is 100%. So 100 minus 30 gives you 70%. So if you want to get what your net profit after tax is, we have the income tax, which is 30%. So you take the 966,000 and we multiply that by 70, which is what we're looking for, divide by 30, which is what we have, and that will give you your net profit after tax. So 966,000 multiplied by 70%, 70 divided by 30, and that will give you 2 million. And let me just write it down here. That will give you 2,254,000, and that's your net profit after tax. Okay. Let me just. Oh, sorry, I took the interest on loans, just so that now our net profit, our income tax is actually 1,950,000. But same principle, you multiply by 70% and divide by 30, and that should give you your net profit after tax. Times 70 divided by 30, and that gives you 4,550,000. But this is not the only way to do it. You can first calculate your net profit before tax, which would be 1,950,000 multiplied by 100 divided by 30, and that will give us 6,500,000. And then to get your net profit after tax, you just say net profit before tax minus your income tax, which would be the 6.5 million minus the 1,950,000, and that will still give you 6.5 million minus 1,950,000. That will still give you 4,550,000. Okay, any questions there? Any questions?
I have no question.
Okay. So then we have our net profit after tax, which is 4,550,000. Now let's continue. So the next step here is to calculate. Okay, so we still need to calculate our balance at the end of the year and the interim dividends and the balance at the end of the year. Now let's see what other information we have been given. If we look here in our partially completed, what's this? In our partially completed cash flow statement and information F, we have been given what the dividends paid is. And then so we can use that to calculate our interim dividends. So how do we do that? Okay, so how do we do that? How do we calculate our interim dividends? If you're calculating the formula to calculate your the formula to calculate what your dividends paid is your shareholders for dividends at the beginning of the year plus your interim dividends plus your final dividends minus your shareholders for dividends at the end of the year, right? That's the formula, and that will give you dividends paid. That's how you get dividends paid. But now we know what dividends paid is. We know what the shareholders for dividends are for the beginning and the end of the year. We also know what our final dividends are from what we were given here in our, what's this? We also know what our final dividends are from what we were given in our note, our retained income note. So that means we can calculate what our, what am I calculating? We can calculate what our interim dividends will be by replacing into that formula. Okay, did everyone get that? Any questions? Okay, I'm gonna assume no questions, so I'm just going to continue. So what we are going to do then in that case is take our, what's this, our shareholders for dividends at the beginning of the year, which are given in 2023 as 2,320,000, and then we, what's this, we plus interim dividends, which is our unknown, and we also plus 2,338,000, and that is our final dividends, and then we subtract our shareholders for dividends at the end of the year, and those have been given as 2,238,000. Okay. And then we equal to dividends paid, which is 5,728,000. Okay, let me just expand this. 5,728,000, right? So this is our formula. So this minus this will give us 0. So we have 2,320,000 plus our interim dividends equals to 5,728,000. And we just take this to the other side. So then our interim dividends will be equal to 5,728,000 minus 2,320,000, and that will be 3,408,000, and we replace those here. 2,408,000. Okay. Any questions? Okay. Oh, is everyone good with that calculation? Okay. I'll continue then. So we'll just add up our dividends. So that will be 3,408,000 plus 2,338,000 to give us 5,746,000. Okay, so now we can calculate what our balance for at the end of the year will be for our retained income. So we take 2,819,000 plus 4,550,000 minus 111,000 minus 5,746,000, and that will give you 1,512,000. Okay, now you're done with your retained income note. Any questions with any of the calculations? Or are we good? If you're good, thumbs up. Sine, are you good? Okay, I'm going to assume people are good if they do not respond. Okay. So next question now, they want us to complete the cash flow statement because it's not complete. So the finished, we don't need to calculate cash generated from operations. They've only decalculated interest paid and dividends paid. So now there's something missing. Can someone either write in the chat or open their mic what is missing in our cash flow statement under the cash flow activities? Under what says the operating activities, sorry. We have cash generated from operations, we have interest paid, we have dividends paid. What's missing?
Taxation paid.
Taxation paid is missing. Okay, now let's see what information we've been given on taxation. So they did give us the income tax expense as 1,950,000. And if we go to the items included under current liabilities, we have the SARS income tax, and it's in 2023 and 2024. So if it's included under our current liabilities, that means we owed SARS, right? So now a formula for that, for taxation paid, that is equal to your SARS income tax, the opening balance, if you owe it, plus your income tax expense for the year, minus your SARS income tax at the end of the year. And we have all that information. So what we are going to do there is just start with the opening balance, which is 86,000. Take 86,000 plus the 1,950,000, and we subtract the 115,000, which is our balance at the end of the year. That will give us our taxation paid. So 86 plus 1,950,000 minus 115, which will give you 1,921,000. And it's an outflow because it's taxation paid. Any questions? Now it's important that you know this formula is like this only when you owe SARS. You owe SARS. If you didn't owe SARS, let's just change the color, then you would minus your SARS income tax at the beginning of the year if it's a refund, and then you add your income tax expense for the year, and then you also add your SARS income tax at the end of the year if it is a refund. So if you owe SARS, you add the SARS income tax. If it's a refund at the beginning of the year, you minus. Your income tax expense will always be a plus, and at the end of the year, if you owe SARS, you minus, but if it's a refund, you add. Okay, so you can have any combination of these in a question. So make sure you look out for that. Then let's continue.
I just want
Question?
to understand, how do you know that we are owing SARS or SARS is owing us?
How do we know if we owe SARS or SARS owes us? Is that your question?
Yes.
Okay, so if something is in current liabilities, that means you owe that person, right? And if your SARS was under current assets, that would mean someone owes you or it belongs to you. So there it's a refund. So you just need to look in the information they have given you. Is SARS a debit balance or is SARS a credit balance? And that will tell you whether SARS owes you or you owe SARS. Okay, is your question answered?
Okay, yes, thank you so much.
Anyone else have a question? Okay, I'm going to carry on. So now we have the cash effects of investing activities. They have recorded the proceeds or sale of fixed assets, and then change in investments we don't need to calculate. Now, what else could we put in cash effects of investing activities that they may not have recorded? Besides having proceeds of sales of fixed assets, what else can be there under our investing activities? Okay, let me try to be specific. In fixed assets, you can dispose of assets, you can sell assets, but what other thing can you do that would be part of a cash flow is if you purchased assets, right? So then what's missing there probably
Mm.
is a purchase of fixed assets. But we don't know if there has been a purchase of fixed assets. They have it. Oh, yes, we do actually. In the information, they say fixed assets were also purchased during the year. Do you see that? So that means we need to now check, we need to now include that as part of our investing activities. If assets have been purchased, we need to record that. Okay, so let's see. Information regarding our assets. Depreciation, that's part of information. We have fixed assets at the carrying value, and then they told us a vehicle was sold at carrying value, meaning this amount that has been recorded here as the proceeds is the same amount as the carrying value of the amount that was sold. Now, this will require you to use your note 3. So it's important that you always remember what your note 3 is. If you remember, your note 3 is like this: your carrying value at the beginning of the year, and then you add your movements. And what are your movements? We have additions, which you add additions. Then we have minus disposals at carrying value, and then minus depreciation, and that gives you your carrying value at the end of the year, right? So now in the information, they have given us the depreciation, the carrying value, the disposal. Let's start with the carrying value at the beginning of the year. It was given as 39,365,000, and then the carrying value at the end was given as 43,095,000. Then we're also given what our disposals were in our, here they are 232,000, so we minus the 232,000. And then depreciation as well was given as 1,620,000. So you see, most of the stuff have been recorded except for additions. So what we need to calculate there is additions. So then if we were calculating carrying value at the end of the year, we would have taken carrying value at the beginning plus additions minus disposals minus depreciation, and we get the carrying value at the end. So now we have to do a reverse of that. So we take our carrying value at the end of the year, which is 43,095,000. Then we add back depreciation of 1,620,000. Then we add back the disposal as well of 232,000. Then we minus her carrying value at the beginning of the year, which is 39,365,000. And that should give you 5,582,000. Okay, any questions there? Reach out, and that will be your additions. Any questions? Purchase of fixed assets. Did everyone understand how we got that thumbs up? Okay. Then let's continue. The next part they want us to calculate is the cash effects of our financing activities. So financing activities is how you fund your business. We are looking at your ordinary share capital, and we're also looking at loans, your non-current liabilities. So there, they've already recorded the change in loans. So this means we'll be looking at the share capital. Now let's go back to the information in the shares. We have a buyback. We know we have a buyback, and the other information we're told is that shares were issued at 17 Rand 20. So we have an issue of share capital, and we also have a buyback. So those will be relevant for our financing activities. Now let's start with the shares repurchased. They only gave us the amount that is above the share price. They didn't give us what the purchase price is, how much do we purchase these for? So that means we need to now calculate the average price, and in order to get what our purchase price was. So how do we do that? We calculate the average price. So the repurchase happened with only the shares at the beginning of the year. So what we'll do there is that we'll take the 1,400,000. So we'll take the value of those shares, which has been given here as 22,910,000, and we divide by the number of shares that were in issue, which is 1,450,000. That's how you get your average share price, by taking the total value of shares in issue divided by the number of shares in issue. So that would be 22,910,000 divided by 1,450,000, and that will be 15 Rand 80 cents. So now we have our average share price and we have the amount above. So we can just take that 15 Rand 80 plus the amount above, which is 3 Rand 70, and that will give us our purchase price of 19 Rand 50 cents. So 1580 plus 370 gives us 19 Rand 50. And now to calculate what the total amount is, we take the 1950 and we multiply by the number of shares that were repurchased, and that's 30,000 shares. Okay, 19.5 multiplied by 30,000, and that gives you 585,000. So that's how much the company spent on the repurchase. So that will be a cash outflow. So repurchase of shares. Okay, 585. What do we think number 3 should be? We've recorded the repurchase of shares, but what else happened? We need to write down what else in our cash effects of financing activities. What else is missing?
Higher proceed and sale of assets.
Yes, proceeds, but not from the sale of assets, proceeds from issue of shares. So you can either write the issue of shares, or you can write proceeds from the issues of shares, right? So remember, we're not dealing with the assets. The assets are here in our investing activities. So issue of shares. Okay. They told us here that shares were issued at 17 Rand 20 per share on the 1st of November, and those were 250,000 shares. So we just take 250,000 multiplied by the 17 Rand 20, and that'll give us the amount we should have. So 17.20 multiplied by 250,000, those will be the proceeds we get from issuing shares. And that will give us 4,300,000. Okay, repurchase should have been negative. Forgot to put that because company is paying for that. Okay, now the last part they want us to calculate is V here at the bottom. Does anyone know what we're supposed to put there? What's the last thing we put in our cash flow statement? What are we supposed to put there at the bottom?
We're supposed to put cash and cash equivalent for the year end. I'm assuming the year end is 29 February 2024. So it's going to be cash and cash equivalent on 29 February 2024.
Correct. 29 February 2024. Okay, let's see. And they have given us what our cash and cash equivalents are. They did give us cash and cash equivalents, the 55,000, but you need to also check in your current liabilities. What do we have there? A bank overdraft. And can someone tell me, what does a bank overdraft do to our cash and cash equivalents? Do we add it to it or do we subtract?
Don't we subtract it?
We subtract it because it means we owe the bank, right? So we need to minus that amount. So to get our cash and cash equivalents at the end of the year, we are going to take the 55,000 and then we are going to subtract the 3,274,000. And that will give us what our, what's this? That will give us what our cash and cash equivalents should be. And that will be negative 3,219,000. And that's your cash flow statement completed. Any questions? Okay, so that's your cash flow
I
statement.
have no questions.
Sorry? No questions?
I said I don't have no questions.
Okay, so let's continue now with question 2, financial indicators. In 2.4, we are asked to calculate the following financial indicators for the financial year ended 29 February 2024. We have first the acid test ratio. Now, for the acid test ratio, what do we do there? It's a variation of our current ratio. It's just that we say current assets minus inventory to our current liabilities. Okay, so current assets minus inventory to our current liabilities. Now, our current assets, the information we've been given for our current assets is that, what's this? It's 9,623,000. So what we'll do there is take the 9,623,000 and then we need to subtract our inventories, which are 4,190,000 minus 4,190,000, and then our total current assets, current liabilities have been given as 18,310,000. Okay, so current assets minus inventory, that is 9,623,000 minus 4,190,000. And that would give us a total of 5,433,000 to the 18,310,000. Now our answer there, we divide current liability on both sides, so that will be 5,433,000 divided by 18,310, which will give us 0.3 is to 1. Okay, any questions on that one? Okay, all good. Then we get to the interim dividend per share in cents. So we did calculate what our interim dividend is. Our interim dividend is 3,408,000. And then we're supposed to calculate it per share. So that will be dividing it by the number of shares. Okay, now let's calculate what the number of shares is. We started off with how many shares? 1 million. We started off with 1,450,000 shares. Now let's see how many we were left with. So 1,450,000 shares, and then what happened? There was a buyback, so we subtract the 30,000. Okay, so minus 30,000, and what's next? Minus 30,000, which will now give us, 1,450,000 minus 30, which now gives us 1,420,000. Now remember, when was the interim issued? Paid on the 31st of August. And these shares issued were on the 1st of November. So we can't include those shares as part of, what's this? As part of our shares for the calculation for the interim dividend per share, because they were not there. So we're just going to use the 1,420,000. Okay, did everyone catch that, or do you want me to repeat?
May you please repeat?
Okay, so our interim dividend was issued on, what's this? Our interim dividend was issued on the 31st of August. The shares issued happened on the 1st of November, so we can't include those in part of our calculation. So we're just going to take the 1,450,000 that we had at the beginning of the year and minus the 30,000, because they said the interim dividends that were paid on the 31st of August are to all the shares that were in the share register. So those that were repurchased, they were not in the share register anymore. So they cannot be part of the, what's this? They can't be part of our interim dividend. Is that making sense? So that's why we minus them.
Noted.
All right. Questions?
No questions.
No questions. Okay, then
No
let's continue. Any questions? Oh, no questions. Okay, then let's continue. So that will give us our interim dividend per share. So what amount are we getting there? We're taking 3,408,000 minus 1 divided by 1,420,000. So what amount are we getting there? Guys, I hope you have your calculators with.
I got 24.
Yeah, it's
240.
240 is correct. Okay. Then the next question now is asking us, what is the percentage return on the average shareholders' equity? What's our raw share? Does anyone know what that will be? What formula do we use for percentage return on the average shareholders' equity? What's our formula then? What do we put at the top? What do we put at the bottom? Okay, so let's break it down. They're asking for, let's break it down. They're asking for the return on the average shareholders' equity, right? That's what they're asking for. So if it's the return on the average shareholders' equity, it's return at the top and the average shareholders' equity at the bottom. So what is your return made up of? That is your net profit after tax. And we calculated that to be 4,550,000. So you have 4,550,000 at the top, and you're dividing by your average shareholders' equity. Now, average, that is a half plus this year's shareholders' equity and last year's. And those have been given here in 2023 and 2024. Last year's was 25,729,000, and this year's is 28,248,000. And then we multiply this by 100. So at the top you have 4,550,000. At the bottom you have a half, and then open your brackets, 25,729,000 plus 28,248,000. Then you multiply the whole fraction by 100. Okay, let's see what that will get us. 4,550,000 at the top, a half, and then brackets we have 25,729,000 plus 28,248,000. Then we multiply all of that by 100, and that should give you 16.86 million. Okay, 16.86%, not million. Okay, any questions there? Okay, so that's the percentage return on your average shareholders' equity. Okay, so now we're done with question 2. That's all you had to do for your cash flow and the financial indicators. Then let's continue over to question 3. Question 3 is interpretation of financial information. So this is where you're calculating there's calculation of financial indicators, and then you're also commenting. Okay, so you need to quote, you need to give figures, everything, and then you need to comment. So let's see the information. The first question we've been given: explain how customers reacted to the change in the markup percentage and whether this benefited the company or not. Okay, so we need to see that. Let's look at question 3. They tell us the information relates to Bright Sun Limited. The company sells high quality solar panels to businesses and homeowners to generate electricity. The financial year ends on the 28th or 29th of February each year. Required: note where comments or explanation are required. You must quote financial indicators and trends with your figures and then give a reason or an explanation on the relevant financial indicators. Then the next part now of that is to, what's this? You look at the markup percentage. So they're saying, sorry, let's see. Okay, so these are the questions that they've given us, the required. Now let's look at the information. Shareholding of Alan Ashwin. Alan Ashwin owns shares in Bright Sun Limited. He is pleased with his investment in the shares. Provide 2 points with figures or calculation. Oh, sorry. Here's the information. Those were just the required. Okay, here's the information. We're looking at the markup. So this is what happened with the markup. It was 40% before, and now we're told markup is 60%. And then we are asked to say how customers reacted to that. So the important information there we need to look out for. Markup, right? It's markup on cost. That affects our sales. So we need to look at how our sales were affected by that. So first off here, number of customers. Last year we have 280 customers. This year we have 245,000. So there, what do you think your comment would be regarding the customers? Because this question has 2 parts to it. Explaining how the customers reacted to the change in the markup percentage, and then say whether this benefited the company or it did not. So let's first deal with how the customers reacted. What do you guys think? How did the customers react? Okay, so I'll explain. As you can see, our customers decreased. We went from having 280 customers, now we only have 245. So customers weren't happy with that change, so we lost out on customers. That would be your first part, explaining that. So on how the customers reacted. Now the rest of the question says, did this benefit the company or not? So yes, we still lost out on customers, but if you see here, the average sales per customer, we went from 120,000 to 160,000. So average sales per customer, so that did increase. On that part, we were better off. And so on that part, yes, we were better off. And even our net profit after tax on sales, it had increased. So we could say this benefited the company. The change in the market, what's this? The change in the markup did benefit the company. Does anyone have a question?
No.
Okay, then let's look at the next one. Comment on the operating efficiency of the company over the past 2 years. Code 2, what's this? Code 2 financial indicators. What financial indicators can we use there? Right. So with this one, what you need to look at is the profits and your operating expenses. on sales percentages. So these ones, where are they? Operating expenses on sales. So that went from 28% to 22%, meaning now our sales has increased and maybe our operating expenses have also decreased. This shows an improvement. If your operating expenses percentage on sales decreases, that's a good thing for the company. So you could have quoted that. Even the one below that, which is operating profit on sales, we can see here it went from 10.2% to 15.6%. That is also a good thing, meaning that we are making a bigger profit now than we were before. So that's an improvement again. The net profit after tax on sales, it went from 8.8% to 13.5%. This is another good thing. And it is also a financial indicator you can use for commenting on the operating efficiency of the company. So those three, you could have used them. Don't use markup. Any questions there? Okay, let's continue. 3.3.1 now asks us, one of the shareholders cannot understand why the debt to equity ratio increased in 2024 despite the increase in the loan. Provide an explanation for him. Now, the debt to equity ratio is your debt divided by your equity. So what happened here? Let's see. Now, information. Okay, so they don't understand why it increased. So let's see what happened here. Your debt to equity ratio went from 0.3 is to 1 to 0.2 is to 1. So they're saying that one of the shareholders, they don't understand why this happened despite the increase in the loan. So we know debt to equity ratio, we know the debt to equity ratio is equal to your debt. We divide the debt by equity. So if your debt has increased, if just debt had increased, that would mean the ratio would decrease. But if it increases, even if your debt has increased, then that means equity has increased as well. Don't know if that's making sense.
Can you please start over?
Okay. The question is, one of the shareholders cannot understand why the debt to equity ratio increased in 2024 despite the increase in the loan. So provide an explanation for him. So we need to give a reason. Why has the debt to equity ratio increased even though there was an increase in the loan? Let's say our loan in 2023 was 1,000 and our equity was 2,000. So then our debt to equity ratio would be 1,000 divided by 2,000, which will give us 0.5 is to 1. Now they're saying what happened? There was an increase in the loan. Let's say we increased our loan by 1.5. So if we increase our loan by 1.5, what happens? Now it's 1.5 divided by 2,000. 1.5 divided by 2,000. And that gives us 0.75 is to 1. Do you see? We went from 0.5 to 0.75. But if you look here, what happened? We went from 0.3 to 0.2. So our loan, our debt to equity ratio actually decreased. This is supposed to be decreased. Our ratio decreased. Our ratio decreased. So what does that mean? Even though the loan increased and if the loan increased, but also the equity increased, that is what would make our debt equity ratio increase. Let's say our equity had increased by 1,000. So now it's no longer 1.5 divided by 2,000. It's 2,000 plus 1.5, not 1,000. So that'll be 3.5. So now debt to equity ratio is 1,500 divided by 3,500. And if we take that 1.5 divided by 3,500, it gives us 0.42. So do you see? it went from 0.5 to 0.42, even though the loan also increased. So what could have done that if the equity had increased as well? That is what would have made our ratio decrease even if the loan has increased. Is that making better sense now?
Yes, thank you.
Okay. So your reason there would be the share equity also increased. So that's why your debt to equity ratio decreased, even though the loan was increased. Okay. Now the next question says the chief financial officer is of the opinion that an increase in the loan was a good decision. Apart from the debt equity ratio, provide 2 points to support his opinion, including one relevant financial indicator. So for this one, your interest on loan is a very important part. So your interest on loan, if we look at our interest on loan, it stayed the same. It stayed the same. Wait, interest on loan 13%. Let's see. Is there anything else on the loan? Okay, so our interest on loan stayed the same, but what else do we have? Increase. Okay, if we look here at Rotke, so Rotke is similar to what Roche is. It's just that at the bottom you have returns at the top, but your total capital employed is both your share equity and your what's this? Your share equity plus your the other one, share equity plus your loans. So it went from 11% to 19.7%. It has increased or it has improved. So in that case, you would say yes, that is a point to say our what's this? It was a good decision to increase the loan because our return is still more than what our total capital employed was. And then it has increased, I mean, the percentage of it has increased. And then what else should we look at? Just give me a second. I'm just still looking at the. Okay. Now, the other thing that's positive is that if you remember from our last question, we have decreased the amount, like the amount we depend on the loan. Before it was 0.3 to 1, now it's 0.2 is to 1. So that's a good thing. And our interest on loan still stayed the same, even though we increased the loan. I don't know if that makes sense. So according to what our debt to equity ratio is, we as the company we are now depending less on the loan. We're depending more on what's this, our equity. So we went from 0.3 is to 1 to 0.2 is to 1. But another thing that's positive then is even though that happened, our interest on the loans is still the same. Does that make sense? So that could have been one of your reasons as well, one of your points. Does anyone have a question? Want me to repeat anything? Questions? Is everyone good? Thumbs up if everyone's good. Okay. And assume everyone's good with that one. Now the next question says, comment on whether the shareholders should be satisfied with a return on investment. Provide 2 points, including one relevant financial indicator. So again, we need to look at depending on the shares. So if we look here, our ROSHA now, which is return on average equity, went from 8% to 15.6%. And that's a big jump. It improved by a big amount. So that's a good thing. And if we now look on We went to 15.6%. That's a good thing. The improvement itself is a good thing. And then if we look at the percentage rate on investments, those are at 7%, meaning other investments are getting 7%, but this investment is getting 15.6%. So that's a good thing. So that is what you would have written there. The fact that it has improved from last year to this year, and the fact that it is bigger than what the other it's bigger than what the other investments are. The return you're getting from this, it's double, in fact, a bit over double. Okay, thumbs up if everyone got that. Okay, if you have a question, you can type in the box, or you can let me know. You can unmute yourself. Then 3.4.2 says comment on the EPS, the earnings per share, and explain its impact on the dividend payout policy adopted by the directors. So let's look at the EPS. The earnings per share went from 113 cents to 224 cents. That's a good thing. It means we've increased the profit we've been making from the last year to this year. Profits have improved or increased. Now, its impact on the dividend payout policy. So let's look at what happened according to the dividend payout rate. Before it was 80%, now we are paying 40%. So that has been a decrease, meaning that before the company was paying out more of their profits, now they're paying out less of the profits. So we have more retained earnings in this case. So retained earnings, that is the retained income. That's the income after you take your profit minus your dividends. That's what your retained income is. So that retained income is usually preserved for other opportunities that the company wants to invest in the future. So that's what's happening here. Before, they were giving out most of their profit to the shareholders. Now they're keeping more of the profit in the business for the investments in the future. Then we look at 3.5. Comment on the performance of the share price on the stock exchange, JSE. Provide 2 points with figures and trends. So let's see here. This is the market price of shares on the JSE. We have 1,610 cents and 1,342 cents. So the first point there would be that the market share price has increased. Now, meaning the value of the company has increased. So first you'd say market price of share has improved from what it was in the previous year to what it is now. So you'd quote those figures. And then you could say this is, as we can see from the information we have here, the returns have been good in this company. Or you could even say the company maybe is positive, its brand or its reputation has been positive in the community. And then now they want us to give 2 points. So first is to compare this year and last year. Now the other part is to compare it to another financial indicator. So we have the net asset value per share. So the net asset value per share, that is the price per share you calculate as inside the business. It's not outside. So the market share price, that is what the people outside value the company, and then the NAV is what the people inside use as the value of the company. And yes, you can see it increased, but what we're trying to compare it to is the market share price, like the question says. So here, according to the NAV, we had 1,543 cents, but according to the JSE, it's 1,610 cents. So this shows that there's a good demand for the shares. It's like if you were saying that your goods, the value of your goods is 50 rand. That is what you are saying. But then people look at your goods and they see that no man, these things should be around 60 rand or above the 50 rand. So that means people, when they're looking at those share prices, they value them at a higher price than what you value them at. So this is a good thing. This shows us that there's a good demand for these shares. Okay, any questions? This is if you are looking in 2024. Zanele, you're good?
Yes, I'm good. Actually, I got to understood the market price of shares and the net value assets. Yeah.
Okay, I'm glad. Okay, so we're still continuing. There's more. Then Alan Ashwin owns shares in Brightsun Limited. He is pleased with his investment in the shares of this company. Provide 2 points or figures or calculations to support his opinion. So these are the you would be looking at the information where if a shareholder looks at this, they'll be happy. Okay, why do people buy shares? Because they want to get dividends. So that's the first part you're going to look at. What are the dividends? So the dividends were 90 cents. So they did stay the same. Yes, you are being paid 90. But how much of that 90 cents, compare it to how much you had originally spent? Like, okay, the dividend is 90 cents, but compare it to like how much is the return you're getting from this. So let's see. Sorry. So provide 2 points. Da, da, da. Just checking something. Okay, where am I? Okay, provide 2 points. Okay, so this tells us how much Ashwin paid. This is the information relating to Ashwin. So they're telling us Ashwin paid 780 cents for the shares, and now he's getting 90 cents per share. So there, in that case, they said we can use figures or calculations. So if we were to use a calculation, 90 divided by 780 times 100, that gives you 11.5%. So he's getting a return of 11.5%. And if you look at other investments, we were shown, right, they are getting around 7%. So he's getting a good return. He's getting a good return from his investment. Don't know if that's making sense. Now, another good thing is this. When he bought the shares, their value was 780, but now those shares are 1,610 cents. So if he were to decide to sell those shares, he would get more than what he has paid for. I don't know if that makes sense. And then we also need to look at what else? The returns. If you if we see here what happened to the returns, they increased from 8% to 15.86%. So that's another good thing that you would say there. Then 3.6.2, the company plans to issue additional new shares equal to 20% of the issued share capital in the next financial year to the existing shareholders. Allen has indicated that he will not take up his offer, explain how this decision will affect his shareholding, provide a calculation to support this. So, an additional 20% of shares of the current shares in issue will be issued to the existing shareholders. Now, what happens is that 20%, let's say we have three shareholders, A, B, and C, and he has 50%, he has 30%, and he has 20%. Now, if they issue that 20%, A will be getting 50% of 20, B will be getting 50% of 20, and C will be getting 50. What's this? 30% of 20, 20% of 20. So someone is getting, of that 20%, each person is getting according to what they have into the business. Now, let's say that C decides not to take those shares. So now these 20% shares are going to be shared between A and B. As you can see, their amount of shares will be increasing, but C's will be staying the same. So that means he'll no longer be at 20% now. His shareholdings will decrease. Does that make sense? Okay. Question?
No question.
Yeah, so his shareholding will decrease. Now we need to prove that using this question. So 20%. So how many shares are in issue? 700,000. So the new share issue will be 700,000 times 20%. which will give us 140,000 shares. So new shares will be 140,000. After this, that means there'll be 700 shares plus 140, which will give us 840,000 shares. So this is how many shares will be in issue. Now, we want to get what will be the percentage of Alan's shares. So now we will take the 360,000 shares that he owns, divide by the 840 times 100, and that will give us the percent that he will now have. So 360 divided by 840 times 100, and that will give us 42.86%. This is after the share issue. Now let's calculate before. Before it was 360,000 divided by 700,000 times 100. 360 divided by 7,000 times 100, and that gives us 51.43%. So you see, he owned majority of shares before, but now he owned over 50% of shares, but now he'll be owning less than that. So that's what you would have written there. Okay. Any questions? So his shareholding has decreased. He will no longer be the majority shareholder. So that'll probably affect decision making in the business. So yeah. Okay. Any questions there? So you would do both calculations, like what is the current shareholding, what is his shareholding after, and then comment. Okay. Any questions? I saw that you opened your mic. Okay, good.
No, please.
Alright, thank you. Then the last question, apart from the points provided above, state two different factors that will influence shareholders to vote in favor of approving of such bonuses. Okay, what are the bonuses? Okay, bonuses for directors and employees. So they are included in the company's budget. Shareholders will be required to vote at the AGM on whether these bonuses should be paid or not. Apart from the points provided above, state two different factors that will influence shareholders in favor of approving such approving such bonuses. So I think here what they're referring to is that the other points that are different is that, let's say we're not looking at what the people made in terms of returns, but let's look at other factors as well, not just the returns that they got, that the company has generated. Okay, so if we look here at, what's this? If we look at our current ratio, for example, before it was 4.3:1, now it's 1.82:1. Now there is a thing such as too good of a thing. That was too high, having it at 4.3, but now at 1.8, it's much more efficient, it's much more controlled. Even with the acid test, it's not 1.1:1, but it's 0.9:1. It's better than 2.5:1. So liquidity, you'd say, is more controlled, it's more efficiently controlled. And then if we look at what else? Okay. Yeah. So if we look at our information from the cash flow statement, they're saying unproductive fixed assets were sold, and that was 1,100,000, meaning we got rid of assets that we are not using. So that's a good thing. Meaning it will improve what's this? It is improving the cash flow because you made a sale, so you're making money. But also it's a good thing because you don't have fixed assets that are just there not being used. And then what else? Before we were generating from our operations 3,863,500. Now we are generating almost double that. So that's a good thing. We've increased cash generated from our operations. And then what else happened? Yeah, number of directors and employees. Before we had 43, now we have 38. But even though that happened, that there was a decrease, our performance of the company also increased. So you could say now we have less people, but they're working harder and improving the performance of the company. So that's another point you could have used there. And that's your question on what's this financial indicators, interpreting them. So analysis of your financial indicators. Any questions?
No question.
So this is where we'll close it off for today. Then yeah. Enjoy the rest of your evening.
Thank you.
Thank you.
Enjoy the rest of your evening.